Hey, what's going on everybody? I hope you're doing wonderful today and that your portfolio are doing just as amazing. 2020 was the year of SPACs and EVs. About $80 billion was raised by nearly 240 SPACs in 2020. That's roughly 6 times the amount raised in 2019. In this video I'll be covering some of the SPACs that performed the best in 2020 that you might not know about. There's some names that have run up quite a ton, but that doesn't mean there's no room for a continuation on that uptrend. Just quick, if you want to support the channel besides pressing the like and subscribe button of course, you can sign up to Celsius and get $40 for completely free if you just deposit $200 and use the code showed on the screen right now, as well as of course use my link from the description. And you can sign up to Coinbase and easily claim $30 for completely free again by answering like 15 questions which should take you like 5 minutes, and get $10 in Bitcoin for completely free again, all without depositing anything, if you just use the link in my description. Anyway, enough of that, let's just get right into the video. So this video might just give you an insight in some of the SPACs that haven't really been covered here in social media, unlike SPE, PSGH, BFT, and all of Chamath's SPACs, and show that there's always opportunities to find in the markets, bull market or bear market, doesn't matter. Right, so first off, let's start off with what is a SPAC? Right, so as per definition, a special purpose acquisition company, also known as a SPAC, is a company with no commercial operations that is formed strictly to raise capital through an initial public offering, also known as IPO, for the purpose of acquiring an existing company. Also known as blank check companies, SPACs have been around for decades. In recent years they've become more popular though, attracting big name underwriters and investors. So the key takeaways from this is that a SPAC is formed to raise money through an initial public offering, so an IPO, to buy another company. And at the time of their IPOs, SPACs have no existing business operations or even started targets for acquisition. So this means that the SPACs are actually what's called the blank check companies, which will then acquire another company, and by doing that making that second company public. But I'll give more example of this when I get into the actual SPACs I'll cover. So SPACs are generally formed by investors or sponsors with expertise in a particular industry or business sector. So this is usually like hedge fund managers or people that work in institutions or CEOs of big companies and people like that. So what's special about SPACs is that it actually allows retail investors to invest in the company that's actually going public before it's actually public. So what also could be called pre-IPO. And that's usually not possible for retail investors, because the other main way of taking a company public is through what's called venture capitals, which is basically where all of the big money get access to the amount of shares that the company wants to take public and then sells it to the public for a higher price. So to put it short, the venture capitals are making bank on an IPO, whereas the retail investors that purchase the shares from the venture capitals when an IPO happens is paying way more for those shares than the venture capital did. A SPAC isn't exactly the same as investing in a company pre-IPO, but it can in some cases be a better option for the retail investors than purchasing when an IPO happens through a venture capital. Alright, now that we've covered that, I just want to play a quick clip of Chamath Palihapitiya where he explains why he likes SPACs and why it's both beneficial for the big money and for the retail investors.
The SPAC is really important. Well, I'll give you why it's important to me, and then I'll give you why it's important to an entrepreneur. Selfishly for me, it allows me to basically be a conduit and act as a principal while I take companies public, meaning I can use my balance sheet to basically empower companies to fulfill a mission that I believe and underwrite in, and then I can be a big part of them as they grow and scale. And so, the only places to make money in the private technology markets are all the way up front at the Series A, the Sequoias and the Benchmarks and the Andreessens of the world. I used to do that at Social Capital. We did a good job, but it's very hard and the returns are extremely long dated. Or you just wait for these companies to get baked and do it at the back end, where instead of putting in tens of millions, you put in hundreds of millions or billions if you're able to do it. And you own the same amount as they end up owning anyways, 10, 12, 15, 20%. And then you can basically help them grow and scale. So that's selfishly, why I was attracted to a SPAC. But then now you get into the Venn diagram part of why I liked it and why it makes sense for an entrepreneur. It's because you can talk about the future. And the most important thing in underwriting returns, as you and I know, in disruptive technologies, is all about future returns. I don't care about 2019 and 2018. Tell me about 2028 and 2029. What is your plan? And the only way that you can talk about that when you're bringing a company public is through an S4 process, because it's a merger, because the S1 process doesn't allow that. The SEC rules are very strict around, basically talking about future prospects, future strategy, future cash flows. You can't even produce a forecast. So the S4 and a SPAC, at the intersection between now my desires and the entrepreneur's desires, is about talking about the future in detail. And then for the entrepreneur, what they get is, a couple of things that are not as important to me, but important to them, which is speed. You take an 18-month process and compress it to 100 days, and certainty of price. So you exactly know what your cost of capital is, and you and your board can underwrite that and decide whether that's too expensive or not. Right now, there's this weird opacity between the private and the public markets. And the most important thing, I think, is that mostly for your viewers or your listeners as well, is that the returns that are available in the private markets are still blocked. There is no access for average, ordinary, normal folks to get access to that return stream. The SPAC does basically do that because it allows you to pull forward the IPO 2 or 3 years into the typical decision-making process that the company has, and then you can own that in an exchange tradable or a market tradable security. And so I think that there's a democratizing effect here, which is very important and powerful.
So the first SPAC is Living Oak Acquisition Corp, ticker symbol LOAK. It was founded by a private equity veteran called Richard Hendricks and investment banker Gary Wunderlich. And Living Oak Acquisition priced an IPO in May in 2020 and subsequently announced a business combination with the biopolymer manufacturer Danimer Scientific. And this company manufactures and supplies biopolymers, which are natural polymers produced by the cells of living organisms. And biopolymers consist of monomeric units that are covalently bonded to form larger molecules, which basically means that they are offering a greener and more eco-friendly alternative to normal plastic as we know it. The advantages of synthetic biopolymers include the potential to create a sustainable industry, as well as enhancement in various properties such as durability, flexibility, high gloss, clarity, and tensile strength. There are several downsides too though, such as the fact that bioplastics are not the answer to reduce marine litter. It won't biodegrade in landfills. It actually contaminates the plastic recycling streams. So basically it's going all in on one or the other, because doing a little of both doesn't do much good in the end. And there's some alternatives that would be more eco-friendly and are used for the same purposes, which could be bamboo, sugar canes, or paper, which all will reduce marine litter significantly. Right, so now I'll take a technical view at Danimer Scientific. And if we go back to the examples I mentioned earlier, which I would go back to, we can see here that when the SPAC actually IPO'd, the ticker symbol was LOAK. But since that was only the ticker for the SPAC, once the company actually goes public, the ticker will change, which we can see right here that it actually has changed to DNMR instead. But if we do take a look at the chart right here, we can actually see that it has actually gone from around $10 back in the beginning of October, and then soared around 210% to a high of $31 back on December the 30th. When the initial spike happened, it made a resistance right here of around $11.75 and a support in the high 10s, which you can see it then bounce in between until it actually broke out right here on November 27th. And then just had a massive run up with a small retracement right here, but other than that then just soared all the way up here to the high, and has then since it hit this high actually had a huge drop down to just below $22. But we can also see that on its whole run up it has actually been riding and bouncing nice off of the 9 EMA, which is this light blue line. And we can see that it bounced off right here, a small run up, bounced off, small run up, bounced off, and then huge run up, and then this recent retracement it actually bounced off of it again. So far it has been a pretty strong support and will in the near future be around $24. But I wouldn't really be concerned if it actually drops back down below the $24 mark, because it is right now at the top of the Bollinger Bands and the RSI is at overbought levels and has actually been since this spike back in late November. So in my opinion, just purely from a technical point of view, it could easily break this 24 level and I wouldn't be concerned if it does. But if it actually goes all the way back down here to $7 mark, which would be the next support level, and it doesn't hold this level and bounce off of it, I would be pretty concerned just from a technical point of view. So what's my thoughts on this company? To be honest, it seems like a pretty interesting company, but it's not really my cup of tea, since this simply is a market which I know and understand so little of. Based on that, I'll just refer to this quote by Peter Lynch, which says, "Average investors can become experts in their own field and can pick winning stocks as effectively as Wall Street professionals by doing just a little research." And now this doesn't mean that you have to be an expert in the field in which you invest, but you always have to know and understand the business and how it makes money, and of course by understanding it, seeing that there's potential to grow in the future. And I just don't know and understand this business enough. So yeah, as I said, this is not really my cup of tea, and I probably won't invest in this. Not because it's a bad business at all, but just because it's so far away from my area of expertise. Anyway, that's all I got for you in this video. In the coming days and the coming week, I'll do a couple of more videos on both great performing SPACs from 2020, but also SPACs to watch out for in 2021. And of course, I'll continue making content like the other videos I've made, like all-around company analysis and stocks to both watch out for in the short term and the long term. So if you want more of that, all I ask is just please give this video a like, subscribe, and let me know in the comments what you think and if there's anything you want me to do a video on in the future. And I think from now on I'll just start putting a quote here at the end of the video like this one. It'll be all sorts of quotes, but just something that's relevant to me when I'm making this video. But yeah, that's all I got. Thank you so much for watching, and hopefully I'll see you in the next one.